So over the last few weeks, if you guys have been watching the market, you've probably realized that the NASDAQ and S&P 500 really have not moved anywhere. We are pretty much at the same price that we were at the start of last week. Intraday moves have been very choppy. We've seen some tight channels get formed. We haven't seen much conviction to either side on the market since last week. Now, with this type of market, in this sideways channeling market, this is when options trading, short-term options trading, can become more difficult. By nature, an options contract needs large, volatile moves for the option premium to increase and for you to take some really high-quality setups. Now, what I've noticed over the last 2 weeks, it's been very difficult to get a solid move on something like the NASDAQ or the S&P 500, and you've had to be very precise within some very tight channels. Now, the way I trade, I like to get confirmation from the NASDAQ and the S&P 500 to take individual stock setups. Over the last 2 weeks, there has not been great confirmation to take short-term options trades. What you've probably also realized, and something I will show you in today's video, as the S&P or the NASDAQ trades sideways, short-dated option premiums will continue to decrease day by day due to the theta decay or the time decay that is priced into the option contracts. Now, understanding these concepts as an options trader, I came into this week expecting more of the same. We have some big earnings this week, Apple and Amazon. The S&P 500, both yesterday and today, have pretty much been at a snail's pace between a 30-point range, not something that I am very interested in on trading short-term options. I came into this week actually interested in trading some futures. I came into this week, opened my futures broker. I wanted to still play some of the supply rejections that I was spotting, but I was cautious of the fact that if I traded a supply rejection with option premiums, if that move was very slow, I may not get the same type of increase on the premium as I would if I was to short a futures contract. So in today's video, I have a little bit of an example of what's been going on with option premiums as the S&P 500 has been trading sideways. And I also have a beautiful NASDAQ 15.9 rejection play that I actually use NASDAQ futures to trade that I'm going to go ahead and talk about in today's video. So to illustrate what I was talking about there in the intro, here is the S&P 500 futures over the last 2 weeks. And what we can see is that we are pretty much trading sideways. We have been at the same price. This is Tuesday's highs of 2 weeks ago. And today we pretty much just held that level, right? That's that 45.90 level, that 45.90 demand. We are pretty much at the same price here as we were 2 weeks ago. Now, during this type of movement on the overall market, most stocks, not all stocks, because there are some outliers, some smaller caps that have been moving, some individual stocks that are still having some nice moves, but the large cap stocks that I prefer to trade, such as Tesla, Nvidia, Apple, they're not going to move a lot, right? They're not going to do much when we see this S&P 500 trade sideways, which is the same thing as the NASDAQ. The NASDAQ also being very sideways. If you were to hold a SPY ETF call option pretty much through this entire period, or a put option during this entire period, while the underlying stock or underlying future contract may be sideways, the option premium will do nothing but decrease on a daily basis as that data starts to eat away at the option premium. So let's take, for example, the SPY ETF, right? Here's the SPY ETF. We've pretty much been at this 456 level for 2 weeks now. If I go to a SPY ETF call option, let's go to the 456 call options. Here's the 456 call options. I'm going to make this a little bit cleaner for us. We can see over the last few weeks, this call option, the 456 call expiring tomorrow, has done nothing but decrease in value, right? We can see since that Wednesday of last week, we have sort of just slid to the downside, even though the SPY ETF has stayed relatively higher to pretty much flat. Now, I know this is a rudimentary concept to some of you, right? I know a lot of you know this, but I make this video just to be cautious, right? For some of you out there that may be newer to options trading, I want to make sure that I get this point across, because if you're not familiar with how this works, right, this could be a really deadly time for some of you that are trading SPY ETF, that are taking some short-term option contracts, right? Maybe swing trading some SPY because you think the market's going to move higher. While you're holding this option premium, even though the SPY is holding up, every day that we just chop sideways, that option premium will continue and continue to decrease. Now, trust me, I'm not saying that there's not intraday opportunities. There absolutely is, playing off certain levels, taking short-term scalps. I'm just giving you an overall idea of what we've been seeing here on the market, sort of a warning to some of you out there to make sure you're aware of the current environment that we're in, understanding that we are pretty sideways here, and it might not be until we get Apple and Amazon earnings on Thursday of this week that we actually get some upside movement. Or, of course, let me rephrase that, some movement in general, right? Could be downside, could be upside. Not just upside movement, but at least some type of movement here on the market from some volatility on the overall market due to that Apple and Amazon earnings. The other thing that I want to point out is just the overall VIX. And we know the VIX is the volatility index, and we can see that the VIX just continues to slide lower and lower. The volatility in the market continues to decline, making it, again, a little bit more difficult to trade those short-term option premiums. Now, even though the market has been relatively sideways, here's the NASDAQ over the last 3 days. We can see we've pretty much traded within the same channel for 3 days now. There are still some very nice supply rejections and demand holds that we can take advantage of. Now, the way we take advantage of these supply rejections and demand holds, avoiding any type of short-term theta decay on option premiums, is by trading futures. And coming into this week, that is really what I was interested in, right? I understood that the VIX is low. I understood that the market has been channeling, but I still am very, very confident in some of these supply and demand levels that I sort of look at on a daily basis, that we go over every day in the pre-market live stream. So coming into yesterday, I was very focused on this 15.9 level on the NASDAQ futures, right? We can see Thursday of last week, 15.9 rejections. We can see Friday of last week, 15.9 supply rejections. So coming into yesterday's trading day, I said to the group, I'm going to look for some NQ shorts off of 15.9. I don't want to trade this with QQQ puts because I don't want to get stuck in any type of chop up here. I don't want to get stuck in pretty much what happened yesterday, which is just some really slow chop. I want to take the futures contract because I don't want to worry about the theta decay that could come into that QQQ option. I just want to play that pure NASDAQ futures action. So we can see, if we go down to the 5-minute chart, if we go into yesterday's morning open, right? Here's the open yesterday on the NASDAQ futures. I'm going to go ahead and make this, gray so we can signify that pre-market. Here's your open yesterday, right? And what we can see is the NASDAQ had 3 5-minute candles pushing to the upside right into that 15.9 supply. We had a really nice supply rejection right there, and this is where I traded that downside with the NASDAQ futures. So here is my trade here. You guys can see this is on TradeZella. I made about $2,500 on 3 NASDAQ contracts. I shorted 3 contracts. You do not need $950,000 to open 3 NASDAQ shorts. You need $3,000 in Tradeovate, which is where I trade. Now, of course, you're not taking 3 contracts if you only have $3,000. That is much too large of a position size. Every point that the NASDAQ trades is $20 on 1 NASDAQ contract. So when I have 3 contracts, every point that the NASDAQ goes up or goes down, I am making or losing $60. And you need to tailor your position sizing around your account value. Of course, the planned risk reward is a little different than what my realized was. My realized was I was actually down about $1,200 to end up making $2,500. So of course the planned R is not always going to be the exact realized R here on your trades. It's not always going to be that way. My planned R was very solid. It was a 2.23 risk reward. I ended up getting about 1.37 playing that 15.9 supply rejection. So made about $2,500 there on that trade on Monday, and it was really all just based off of the 15.9 supply rejection. So still trades out there, right, in this market, still supply rejections, and even just today, still demand holds like we saw here. Very nice demand hold today of that 15,740, and still opportunity. Now, let's take, for example, you were to take a QQQ put here on that NASDAQ 15.9 rejection, right? Right there, you can see that NASDAQ 15.9 rejection that we traded. If we go to, let's say, the 382 puts, the 383 puts from Monday, from yesterday, right? Here's the move you got, right? It's not that big of a move, right? And you got your little scalp there, about a 30% scalp, but look how quickly this thing decayed, right? By just about an hour later, you're completely flat on that QQQ option, right? And if we go to the NASDAQ, an hour later on the NASDAQ, you are still lower than where you were, right? So you can see, right, an hour later, the NASDAQ retraced back to around this 15,880 area, which was still lower than your entry, right? It's still lower. You are still right, and you are still, the price of the NASDAQ futures is still lower than where you entered. But on that QQQ option, you are actually back to break even, and this is the problem that you are seeing here in this market. With this choppy movement, right, you can go back to break even and maybe even red, even though the underlying is still in your favor, right? This is a problem that you're seeing and something I wanted to make a video on today. So guys, that's about all that I have for you. I'll keep you updated if I continue to trade futures. If we continue to see this sort of sideways action and we continue to just play these supply and demand levels, I'm definitely going to favor trading futures here in this market environment. But once we get those big breakouts, once we break this channel, once we get some real movement on this market, I'm definitely going to be back in that option trading, right? That's what I know. That's what I love. But as of right now, I need to adapt to what I'm seeing on the market. And as of right now, trading, 0 DTE, 2 DTE option contracts is not going to work very well here in this choppy market. I hope you guys enjoyed today's video. Press that like button, subscribe to the channel, and I hope to see you in the next one. Peace.